When it comes to building wealth before retirement, there's no shortage of financial advice floating around. But if you try to follow everything, it can become overwhelming very fast. So today, I want to simplify it. Here is the short list, the things worth focusing on if you want to set yourself up for long-term financial success. I'm Eli Freeman, a certified financial planner, and let's look at the data. The first thing is living below your means. Living below your means is the foundation of wealth building. If you consistently spend everything that you earn, there's nothing left to save, invest, or use for opportunities. Cutting lifestyle expenses below your income creates what is called margin, and that margin is where wealth grows. To do this effectively, it's critical to stay out of things like credit card debt. Credit card balances are compound interest that's just working against you. Often this is at 20% or more interest per year, which makes it almost impossible to build wealth because every dollar you send to that credit card company is a dollar that's not compounding in your own portfolio. Over time, the people who live below their means and avoid high interest debt have more flexibility, more freedom, and a lot more financial security. The second part is to buy a home that you can actually afford. Housing is often the biggest monthly expense, which makes it one of the most important to get right. A common guideline is to keep your housing payment under 28% of your gross annual income. Personally, I prefer to see that closer to 20% because homeownership always comes with maintenance costs, repairs, and unexpected expenses that can catch people off guard. Sticking to this guideline allows you to balance your financial life instead of pouring all of your resources into your home. Too much house can crowd out your ability to invest, travel, or handle off-chance emergencies. On the other hand, a home that fits comfortably in your budget can provide stability and become a long-term wealth builder for your family. The third is to not overspend on cars. Cars are one of the most common wealth killers because they lose value so quickly. The moment that you drive a new car off the lot, it begins to depreciate, often by thousands of dollars in the first year alone. Buying the, quote, nice car that stretches your budget can mean less money saved for retirement or investing. Over decades, that trade-off can actually cost you hundreds of thousands of dollars in missed growth. In fact, I made a full video on this topic, and it's called Why Buying a Brand New Vehicle is the #1 Wealth Killer, where I break down how overspending on cars can literally cost you millions of dollars in assets over your lifetime. Choosing reliable, affordable transportation frees up resources to put towards things that actually build wealth, not drain it. The fourth is to invest tax efficiently. Taxes are one of the biggest silent drains on wealth. If you don't pay attention to them, using accounts like 401ks, IRAs, or HSAs can save you thousands of dollars over your lifetime. Beyond that, being thoughtful about where you hold certain investments like stocks and taxable accounts and bonds and tax-advantaged ones can make a meaningful difference. Even a small increase in after-tax returns can compound significantly over time. The bottom line, the less you pay in taxes unnecessarily, the more that you have in your pocket working for your future. The fifth is to invest consistently. It's easy to overthink investing, especially when markets are volatile. But the truth is consistency almost always beats timing. By contributing regularly, whether markets are up, down, or flat, you benefit from compounding and from dollar cost averaging. Dollar cost averaging means that you're buying more shares when prices are low and fewer shares when prices are high, which smooths out the average cost of your investments over time. This process removes the pressure of trying to time the market and helps reduce the emotional roller coaster of investing. Over decades, this steady and disciplined approach of contributing monthly is one of the most powerful wealth building habits that you can develop. The number 6 is a way to take out big risk, and that's diversify. No one knows exactly what the future holds, which is why diversification is essential. Putting all your money in one stock, one asset class, or just one part of the world exposes you to unnecessary risk. Diversification spreads that risk out so that not one bad investment doesn't derail your entire plan. A well-diversified portfolio combines growth potential with some stability, helping you stay invested through the ups and the downs. Over time, diversification doesn't just reduce risk, it also makes it easier to stick with your strategy during those tough markets. None of these are flashy strategies, as you can probably tell, but the data is clear. People who consistently do these give themselves the best chance of retiring comfortably. And if you aren't doing these yet, there's no better time than right now to begin. As always, this isn't a recommendation for you to make specific financial moves, but it's a framework to help you think as you plan for your future. If you found this video helpful, why don't you click subscribe below, and I'll see you next time on the Data Brief.